welcome back once again to our tax guide session for individuals. So, proprietorship series for today, we're treading towards our last part of the series as we tackle about qualified business expense. Just a quick recap, we were able to differentiate our personal hobby versus our intent to pursue profit by doing the things we are passionate about while actually earning income. And we were able to understand the bigger picture of establishing a sole proprietorship business structure. Now let's talk about our operations. And the biggest chunk of our daily business operations are expenses. Today we'll address what constitutes a qualified or valid business expense in the eyes of the IRS. As we move along towards our discussion, we'll be guided by the following principles. First, profit motive. We already have a clear-cut definition of this one in our previous sessions. For a review or a recap, you may check our previous episodes in this sole proprietorship series. Number 2, business expense should be ordinary and necessary. Number 3, business expenses should be distinguished as business activity from personal activity. And lastly, burden of proof rests on the client or the taxpayer. We'll talk more about each one of these as we move along. IRS says that business expense should be ordinary and necessary. An expense is ordinary if it is common and accepted in the taxpayer's industry or type of business. Expense should not be unusual or unique to the taxpayer's specific situation. An expense is necessary if it is helpful or useful in furthering the taxpayer's business or income producing activity. It doesn't have to be essential, but it should contribute to the business success. For example, you own a small graphic design business. Purchasing a subscription to graphic design software, example Adobe Creative Cloud, is an ordinary expense. It is common in your industry and directly contributes to the service you offer. Most graphic designers use software like this to create designs for clients, making it a regular essential cost of doing business. Meanwhile, purchasing a luxury sports car and branding it with your business logo to use as a marketing tool would generally be considered non-ordinary or extravagant in most cases. While the car might provide some marketing value, it is not typical for a graphic design business to use a luxury sports car in its operations. It would likely be seen as an excessive or personal expense. For necessary, let's say you own a small coffee shop. Purchasing a commercial espresso machine is a necessary expense because it is essential for preparing the coffee drinks your business sells. The machine is directly related to the core operation of your business, making and selling coffee. Without it, you cannot effectively serve your customers. On the other hand, installing a high-end sound system to play background music in your coffee shop should be considered non-necessary. While pleasant background music may enhance the customer's experience, it is not directly required for your coffee shop to function. It's an optional discretionary expense that does not directly contribute to the core operations. Additionally, IRS mentioned another two vital keywords: reasonable and appropriate. The expense should be reasonable in amount and appropriate for the business needs. The expense must have a clear business purpose and not be primarily for personal benefit. Also, it should not be excessive. Let's say, for example, paying for a $500 flight for business travel is reasonable, but paying for a $5,000 for a cruise ship for business travel is excessive. Also, business expense should not be personal in nature or can't be a part of personal use. For example, eating out with professional colleagues, talking about work versus eating alone while working. Claiming the amount paid for food bought while eating out with professional colleagues talking about work while food paid for eating alone while working can't be claimed as valid expense because naturally, food for your own nourishment is personal, regardless you're doing work or not. Moreover, when we buy something like an asset to further our business operations, the amount must be paid in the current year and the asset must be put in business use in the exact same current year to qualify as a business expense. Up next, there should be a separation between business and personal activities. In our previous episode, one of the steps in establishing a sole proprietorship is establishing a separate business bank account, mainly settling business bills and transactions. For the IRS, having a business bank account solely exists for the purpose of settling business transactions. Having a personal bank account to pay business expenses, this may disfavor the taxpayer's claim of that business expense. Therefore, there should be no commingling. Commingling happens when the business owner mixes personal and business funds. The owner uses business funds to pay for personal items. Example, paying personal bills out of the business account. Again, business bank account for business expense and personal bank account for personal bills. You may have a separate business credit card, but the key principle should be that certain account must be solely for the business and not to commingle it with your personal expenses. Lastly, burden of proof refers to the obligation to present sufficient evidence to support a claim. The taxpayer must show through receipts, invoices, and proper record keeping that a particular expense was ordinary, necessary for the operation of the business. This doesn't mean that when it's filing a tax return, we need to attach and submit all our receipts claimed as business expense. But in case of an IRS audit in tax law, this often means providing documentation and records to prove that expenses were legitimate, business related, and deductible under the tax code. Business expenses must be clearly documented, and it's a taxpayer's responsibility to maintain accurate records. Circling back, when you also have your business credit cards settle business expenses, do take note that credit card statements do not equate to sufficient receipt. One must keep the actual receipt of proof of payment for each business transaction. Before we end the session, here's a short acronym ONRA as your guide to think about your future business expenses. Again, ordinary, necessary, reasonable, appropriate. Hope you're excited to do business in line with the IRS guidelines. See you on the next episode. And that's it for our session for Sole Proprietorship Series Qualified Business Expenses.